Selling a house, avoid taxes on capital gains on real estate. Hi, this is Merloni Pedrosa with eXp Realty in Las Vegas, Nevada. Now, the money you make on the sale of your home, might be taxable. Now, here's how it works and how to avoid a big tax bill. Now, how does a capital gains tax work? The IRS and many states assess capital gains taxes on the difference between what you pay for an asset, your basis, and what you sell it for. The capital gains taxes can apply to investments such as stock or bonds and tangible assets like cars, boats, and real estate. Now, the good news about capital gains on real estate, the IRS typically allows you to exclude up to $250,000 of capital gains on real estate if you're single and $500,000 of capital gains on real estate if you're married and filing jointly. For example, if you bought a home 10 years ago for $200,000 and sold it today for $800,000, you'd make $600,000. If you're married and filing jointly, $500,000 of that gain might not be subject to capital gains tax, but $100,000 of the gain could be. The bad news about capital gains on real estate, your $250,000 or $500,000 exclusion typically goes out the window, which means you pay tax on the whole gain if any of these factors are true. The house wasn't your principal residence. You owned the property for less than 2 years in the 5-year period before you sold it. You didn't live in the house for at least 2 years in the 5-year period before you sold it. Now, people who are disabled and people in the military, foreign service, or intelligence community can get a break on this part. You already claimed the $250,000 or $500,000 exclusion on another home in the 2-year period before the sale of this home. You bought the house through a like-kind exchange. Basically swapping one investment property for another, also known as a 1031 exchange, in the last 5 years. You are subject to expatriate tax. If it turns out that all or part of the money you made on the sale of your house is taxable, you need to figure out what capital gains tax rate applies. Short-term capital gains tax rates typically apply if you own the asset for less than a year. The rate is equal to your ordinary income tax rate, also known as your tax bracket. Long-term capital gains tax rates typically apply if you own the asset for more than a year. The rates are much less onerous. Many people qualify for a 0% tax rate. Everybody else pays either 15% or 20%. It depends on your filing status and income. How to avoid capital gains tax on a home sale. Number 1, live in the house for at least 2 years. The 2 years don't need to be consecutive, but house flippers should beware. If you sell a house that you didn't live in for at least 2 years, the gains can be taxable. Now, selling in less than a year is especially expensive because you could be subject to the short-term capital gains tax, which is higher than the long-term capital gains tax. Number 2, see whether you qualify for an exception. If you have a taxable gain on the sale of your home, you might still be able to exclude some of it if you sold the house because of work, health, or an unforeseeable event, according to the IRS. Number 3, keep the receipts for your home improvements. And the cost basis of your home typically includes what you paid to purchase it, as well as the improvements you've made over the years. When your cost basis is higher, your exposure to the capital gains tax may be lower. Remodels, expansions, new windows, landscaping, fences, new driveways, air conditioning installs. They're all examples of things that might cut your capital gains tax. So if you're thinking of buying or selling right now in these areas, I would love to be able to assist you. Reach out at any time because we are always here to help. It's free advice. Just call us here and we will be sure to serve you to our best of our ability. And as always, everyone, have a great home selling and buying time, and remember, be better every day.